Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. Today's guest is Jonny Cattani, and he is the founder of Cattani Capital Group. He is a former stockbroker turned real estate investor and has been in commercial real estate for 3 years. He's been an investor for 6 years, and he currently manages a $650K short-term rental fund and specializes in helping busy professionals build wealth through passive income. He's also the host of an investing podcast called The Cash Flow Chronicles, where he interviews top experts in real estate and in business. So, Jonny, welcome to the show.
Hey, Keith, thanks for having me. Grateful to be here.
Yeah, absolutely. If we could maybe start with your story, it sounds like an interesting journey going from a stockbroker into real estate. But tell me a little bit about, kind of where you grew up and what eventually led you to real estate.
Yeah, so like you mentioned, started in the public sector. Before that, though, grew up the first half of my life in New Jersey, and then the second half of my life in Utah. Ended up going to college here in Utah, Utah State for a little bit, and then the University of Utah. And, so there's a family business, construction business. I did my hand at that. My family and business did not mix. I know plenty do it very well, but mine did not. So I left that pretty early on after college and wasn't really sure what I wanted to do, right? Like most 20-year-olds. And remember, this is 10 years ago. So it's not, I'm not that old, but also, this is like social media is just barely taking off. Right. And so you didn't really know about the opportunities now. Like you see these 24-year-olds are already millionaires, that wasn't really happening when I was 24. So wasn't sure what I wanted to do. Ended up having a friend who worked in the public sector, was a stockbroker for a discount brokerage. And she was like, hey, I think I can get you a job. Like, you might really like it. And got in there, studied for my 7, and I was hooked. Like, I absolutely loved it. It's extremely fast paced, obviously, right? And, money's flying everywhere and you're talking to these people. And it was a lot of fun, but the issue that I was having was not really with the public sector as much as more the corporate ladder, right? Like, as most people can say. So you move up super fast and then you kind of plateau. And that's what happened is I stopped moving up and it was kind of the same thing every day. But one thing I'm grateful for is I got to the point where I was working with high net worth clients, 5 million in assets or more. And, really what my job was try to get them to consolidate as many assets as they could, right? So I was constantly talking about their outside portfolios. And what I realized is so many of them had real estate in their outside portfolios and some like very, very significant real estate portfolios. And I remember one client specifically, he was a pilot and he had like 24 single family houses in his portfolio, rented to all pilots, like just a really, really solid guy. And we would chat almost daily and I'd pick his brain. And finally I was like, all right, there's something to this. So I started reading books, of course, Purple Bible. I think many people can can mark that as their Genesis moment, Rich Dad, Poor Dad, podcasts. And I was like, okay, like this is what I want to do. But I just had no idea where to start. Right. And of course, in hindsight, you learn everything. But so I tried my hand in the fix and flip game, tried my hand in the wholesale game. It's so transactional and more power to the people who are successful at it. It just was not for me.
Yeah.
And so I was like, okay, there's something to this commercial real estate thing and I want to try it. And, me being me and, being like, all right, I'm going to go straight to commercial real estate. So after I left the corporate world, I tried my hand in the startup world of tech because here in Salt Lake City, we have a very big, they call it the Silicon Slopes.
Right.
And so I started at a tech startup, was like one of the first 100 employees, like dialed. And then COVID hit and they laid off all their top sales reps. And it's kind of bittersweet because it's like, man, I was a top sales rep, but also like I got laid off. So I took some time off and I was like, all right, it's time to get into this commercial real estate thing. So I found a group here called Greenlight Equity Group. Great group. They buy apartments in Columbus and Oklahoma City, still do.
Okay.
And worked with them for a year, helped them set up all their back-end automation, all their CRM stuff. I just come from the sales world where that's like all you do, right? Is like your pipeline and blah, blah, blah. So I was like, cool, this is the value that I can add. And stayed with them. We scaled from 70 units. They had 70 units when I started, and we scaled to 572 units in less than a year.
Wow.
And I was hooked. Yeah, I was hooked. I mean, needless to say, right? But what I realized is my skill set being sales and kind of, stockbroker, my skill set is talking to people, networking, meeting people, which ultimately led me to capital raising. Mm-hmm. So I joined Raise Masters, which is, still in my biased opinion, the best mastermind group for elite capital raisers. Joined them and was another Thompson's early
deal, right?
Hunter Thompson. Yep.
Yeah. It's funny. I was listening to his book for a second time on my run this morning. So, they mentioned the mastermind. So cool.
Yep.
Go ahead.
Yep.
Sorry.
No problem at all. Please interrupt. This is obviously a long answer to a short question, but, so I also had listened to his book, which is what got me hooked. And like, I was like, okay, I like this guy, right? Because if you know Hunter, which I've gotten to know him, very closely now over the last couple of years, is he loves to have a good time, but he's a no BS guy, which is just me to a T. Like, I don't like fluff. I will never. And this is the New Jersey, right? We don't BS, right? I'm going to tell you exactly how it is. And that's how he is. And so joined Raise Masters ultimately led me to, I hadn't done my own raise yet, and I had done some smaller investments with Greenlight. So I didn't have a ton to stand on. So I was really going out to friends and family and just being like, hey guys, like, take a chance with me. There's really something to this. I've been studying it. Here's what I've learned. These people can vouch for me. Obviously Hunter's raised tens of millions.
Yeah.
And so I found the TechVestor short-term rental portfolio, which we ended up doing a fund for. We raised $650,000 for it, like you mentioned. That's been incredible. In fact, I literally before this got an email that the quarterly distribution hit my account, which is amazing. Nice. So I invested alongside all my investors as I do with all my deals. And yeah, it's ultimately led me to realizing that what I realized, to really bring it to a T, is that, and I've gotten in some arguments with this about people who feel differently, but nobody really gets rich, for lack of better words, from the stock market, right? You can, but it's really a very long term. And don't get me wrong, you should have a long-term outlook for real estate as well. You shouldn't be trying to just, this 18-month flip thing, like that period's over, right? And we're back to the 5-7 year hold period. But over 5 to 7 years, I will put commercial real estate, and I mean specifically more like, multifamily, self-storage, mobile home parks, industrial, takeout office. But I will put those assets up against the public sector for 7 years, literally 1,000 times out of 1,000 times. Yeah. Right. And so what I realized is that this is really where the wealth is built and maintained and, ultimately, led me to where I'm at now.
Yeah, that's great. A lot to unpack there, but what about different transitions as far as, what you saw maybe on the stock side? I still do both. I still have, company 401k, that kind of stuff. And I think it's done well for me. But I definitely have seen a bigger gain in wealth from the real estate side of things. But just kind of what are some of the differences that you saw being, intimately involved in both of those? Yeah, that's a great question. So I would say the common denominator, and this was a great point made to me by a good friend who's just, will die on the hill of the public sector and more power to him. And I don't want to take away from it because I do think that it's important in your ultimate portfolio to be so diversified that you're also in the stock market. Absolutely. I am as well. And the common denominator is risk, right? How much risk you're willing to take on. And what he was trying to say is, if you're willing to take on a lot of risk, you can get rich in the stock market. And that's absolutely true. But when you look at the risk you need to take in the stock market to get rich, you're talking about a serious amount of risk, right? Yeah. Where you're talking maybe a newly IPO'd or maybe even beyond that, like a pink sheet, right? Where you're just, you're really putting your faith in this company that could absolutely go to zero. And I have seen it happen countless times when I was a broker versus, when you speculate in real estate, and I want to make a blanket statement that, but ultimately when you speculate in real estate, let's take a good speculation, right? Like C-class value add, right? And, it's pretty dilapidated. Maybe, it's only, 80% occupied, right? Bad debt, you name it, right? It's an overhaul. But in the end, you still have real estate, right? And over a 10-year period, that asset is going to appreciate, right? Sure. Now, barring horrible management and bad ownership, which, we can get to later, but barring that, you still own real estate. And if you do it correctly, it's going to cash flow and it's going to appreciate versus some pink sheet stock that may not even actually end up being listed on an actual exchange and it goes to completely zero and your money is completely gone. Right. Yeah. So that to me is really the biggest difference when it comes to those two. Yeah, I agree with you. I think that there is that. I mean, I like the fact that it's a hard asset that you can go out and touch it, and it, like you said, it's not going to go to zero. It's going to have value for somebody. Now, if managed wrong, and we'll see some of that, coming up, and there's stuff going on right now where you're going to see some stuff go back to the bank. With, bad debt that they took on, not bad debt, but it turned bad because it couldn't get out of it. So, there's situations like that, but the bank's going to come back and they're going to have the value of the asset itself and they'll turn right back around and sell it. And so there's always that opportunity, but I do think you need to look at, who it is that, is managing the deal. Can they follow through on the business plan, that kind of thing. But yeah, I totally agree.
Absolutely. Yeah. And the other thing too is, even, some of these mutual funds and whatnot, you're never going to call the fund manager and, be one phone call away from the fund manager and get him on the phone and do your due diligence and ask about what he's like as a human. Whereas, with a operating group or a sponsorship or fund managers, whatever it may be, my cell phone is listed on my website. You know what I mean? Like you can literally call me and talk to me and do your due diligence and we can meet in person. When I do my due diligence, I'm meeting everyone in person, only doing business with people I've met. Right. Mm-hmm. So when it comes to your risk adjusted returns and your risk adjusted investments, the private sector really just checks more boxes, in my personal opinion, having, been in both.
Yeah, for sure. What about, and we can talk about some of the, different benefits that you can get by investing passively. But before we go there, tell me a little bit about, the STR fund that you're in. You had mentioned that before the show started, it's a fund, kind of a fund within a fund. But is there a specific strategy that the overall fund is going for when it comes to SDRs? Are they in vacation areas? Is it traveling nurses? Just kind of what's the game plan on that one?
Yeah, that's a really great question. So it's really awesome because it's really all of those things. So it's a nice solid mix of vacation destinations and more like urban, like you said, travel destination, right? There's some in Memphis, right? Where you obviously have a very large medical, a lot of hospitals. And so you get a lot of travel nurses, and there's some in different parts of Florida that are vacation versus that same kind of concept, right? So it's a nice diversification. Ultimately, what they're going for, what they found is that, there's really only one or two that I've seen significantly that are private short-term rental portfolios that are at the that are institutional grade. And what I mean by that is, you have a lot of people who have really great short-term rental portfolios, right? Mm-hmm. Maybe 5, 6, maybe you have 10 or 12, but this one has 75, right? And what they realize is, there really still aren't a lot of institutions that are involved in short-term rentals, right? You've got Zillow obviously buying, single family residences, but they're really on the buy and hold and kind of the flip game there and not really the short-term rental game. So what they're doing is they're creating these unique experiences. So you're not just going to Scottsdale and staying in Airbnb. You've got a house that's all pink for a bachelorette party with a pool in the background and pink chairs and fire pit. You've got, one that's multiple that have mini golf courses and basketball courts and, game rooms. So you have these unique, right, very upper tier, not just your run of the mill short-term rental, but these like premium short-term rentals that are going to create a lasting memory. And, each room has a different theme and you've got your Instagram spots, mm-hmm. And ultimately what they're going for on the exit is an institutional buyer to come in and buy the entire portfolio, right? Because an institutional buyer is not going to come in and buy 5, 6, 10, right? They're going to want 50 plus 75 short-term rentals that are cash flowing. And I mean, this thing is, just last month, the fund had its first month. So, last year was the inception. This year they were buying a few more. So they have a second fund as well, but they were still buying some more for the first fund. And so this quarter will be the first quarter that all 75 are up and operational and flowing. Mm-hmm. So the cash flow is still going. I think we're about 2% cash on cash so far this year. So not great in terms of, we haven't quite hit our 9% pref, but it's only the first full year that it's been fully operational and stabilized, and even the first quarter that it's been fully stabilized. So ultimately, what they're going to is that institutional grade and getting to that high premium exit. Yeah.
What I guess another question on that, and maybe there's a variety of this, or I don't know, but are these single family homes that are being purchased and then converted into an Airbnb or a short-term rental, I guess would be a better way of saying it. Or are they existing short-term rentals that are picked up? What is there a combination of both? Just curious more than anything else.
Yeah, totally. So yeah, it is funny how Airbnb has kind of become the short-term rental standard, right? Like Kleenex.
Right. Exactly.
You almost forget about VRBO, but they are on both. So yeah, that's a great question. It is a combo of both. The ideal scenario is buying a residential house, right? Because one of the biggest factors here is, when you buy a residential home, as we all know, right, you buy on a comp, right? On a comparable. Basically, your home is worth what the most recent comparable has sold for. And so ideally you buy there, because ultimately what they're doing is they're turning it into a commercial product. And once it becomes a short-term rental, it's then sold on an NOI. So ideally they're buying residential with the comps, right? Especially now with comps coming down, median home prices dropped a little bit. But that being said, there are some markets, Scottsdale, Phoenix area being one of them, as you know, many of your listeners have probably seen, that some of the short-term rentals have struggled. And really it's because they weren't maximizing the space. So what TechVestor comes in and does is they buy it as a short-term rental, right? Still undervalued, but then they go in and they upgrade it, right? Game room, you know, mini golf course, whatever it may be. So it's a mix of both. The ideal scenario is buying a residential home, but on the flip side of that, you know, that means typically more work to get it to, you know, the premium grade that the fund wants, versus when you buy it as a short-term rental, it's going to have some of those qualities already and may not need as much work. So it's kind of a give and take, but for the most part, you know, they've got a proprietary underwriting software. One of the board members is on the National Board of Realtors. And so they have access to the national MLS. So they're underwriting about 50,000 listings a month with this software, basically AI.
Oh, wow. Okay. Yeah.
Yeah.
Oh, that's great. And that makes sense. You know, why the cash on cash would be a little bit lower, right now. Just, you know, when you're getting these things online, they just take a little bit of time. You know, I would say probably, you know, from everything I see out there as well, and just talking to different friends that are in short-term rentals, you know, it hasn't necessarily been the easiest year, with that. I know there's still pockets where, you know, it's super, super hot. We just bought our first one at the end of the year, at the end of 2022, and got it online just basically in December. And so the first months available for rent and stuff were in January. It took a little bit to get it up and going. It's humming along really nicely right now. But you know, the first couple months, just, you know, you don't have the notoriety. One of the other things I'm starting to see, and I'm sure you guys will see this as well, is, you know, if somebody comes to a short-term rental and they have a great experience, oftentimes they come back. So I've already had, you know, even just being about 7 months in, I've already had repeat customers that have come before, and they're coming again. So I think you'll see some of that.
That's the best thing you can have, right? Is those repeat customers, because that's free marketing. Obviously, they're leaving good reviews. Airbnb has a really great system of almost forcing you to leave a review when you're done. You know what I mean? Which really helps a lot. So it's really nice.
Yeah, it's good. It's a little different on you know, Airbnb versus Vrbo when it comes to the review. I've noticed, you know, I typically get my reviews from the Airbnb. I get them from both, but the majority of them are because you keep getting that email, you know.
Yeah, that email, and you can't see what they said about you as
exactly.
You know, as a patron, unless, you know, you leave a review too. So they really have a good system.
They do. I agree. You know, I know you mentioned before the show started, and I'd really like to kind of get into hearing some of the details on the oil and gas. We haven't had anybody on talking about oil and gas. I do know, you know, some acquaintances like Michael Blanc, who's kind of, he hasn't switched to that, but he's including that now as in addition to multifamily. And a lot of people are having to do kind of, you know, extra stuff just because the market's crazy right now. Things have slowed down, deal flow. I think things still aren't penciling out quite yet, in some cases. So anyway, I'd love to hear the play on the oil and gas and kind of what that looks like.
Totally. Yeah. So, basically just like you said, right? So the biggest thing for me, and I know a lot of your listeners are kind of in the same boat, high income earners, right? Tech specifically, right? I come a little bit in tech, but, that's where a lot of my people come from, is high income tech earners, right? And more specifically on the sales side, which we all know get dragged through the mud when it comes to getting taxed on their commission. Mm-hmm. And so it's a couple things that led to this. One, like you mentioned, multifamily specifically, and real estate kind of, just to put it mildly, transaction volume way down, relatively speaking, right? Especially if you look back over the last 3 years, it was a freaking rocket ship, right? And more specifically to that is the cash flow has all but dried up. There are still great real estate deals out there, and I absolutely love real estate. Haven't lifted my, ear from the ground when it comes to paying attention to real estate. It's just that you also have to listen to your investors, right? And this is what I tell new people and anybody that's focusing on capital raising, is you got to listen to your investors, especially starting out. I don't have a massive list of investors, so I'm pretty close to most of them. I've had at least one phone call with pretty much my whole list. Yeah. And ultimately what I've realized is they want cash flow, right? They want a couple things. They want cash flow and they want tax advantage. And what this opportunity gives is both. Now, cash flow is a little bit ancillary because it is a commodity and it ebbs and flows, as we all know, right? Even if you're not really paying attention, all you got to do is pay attention to the gas pump. You know what I mean? Right. There's an ebb and flow, and that affects, ultimately the cash flow. But more importantly is the tax advantage. So I'll preface with this. It is a 506c, right? So accredited investors only, but the tax advantage is insane because typically how it works, and I'm not a CPA, but typically how it works, right, is when you're on the general partnership or you're actively involved, there's a certain amount of hours you need, right, to be a real estate professional in order to get any of your tax deduction depreciation against your active income, right? Which is why you see a lot of, the husband is a GP and the wife is a real estate agent, right? And she's she's the real estate professional, and they file jointly and boom, right? Great opportunity there. Love that teamwork. But there's a loophole in oil and gas where you start as a general partnership. So all the investors, myself included, we all start as general partners. Then starting January 1 of the following year, so in this case, January 1, 2024, we'll all get moved to the limited partnership. But because we were on the general partnership at inception, we will get up to 75% of our investment amount. So the minimum for this is it's a big minimum. It's $100,000 minimum. So basically up to $75,000 if you invested the minimum deducted directly from your active income. That is massive when you're a high income earner. You know what I mean? Sure. And you're up in that 40% tax break. So that is the number one thing, right? And that's what's gotten the most attention from people. So this is a cool opportunity because it appeals to real estate people because it's a fund of sorts, right? So it's a $200 million fund, but you're investing directly with the operator. And basically what they're doing is they're doing like a value add. They're going out and they've got a little over 21,000 acres in the Permian Basin, which if you've followed oil and gas at all is like the honey hole. Right. Like this is where the oil is in the world. Like this is it, like forget Saudi Arabia, there's rumors that they're running out anyway. Like this is where the oil is. So what they're doing is they're proving that the area where they're drilling is that there's oil there and it's worth bringing the infrastructure, meaning the pipelines out to there and hooking the pipelines out there. So a bit of a risk there for sure. But with the technology you have now with geology and all of those things, they already know the hydrocarbons are there. So now they're going to go in, they're going to drill anywhere from 18 to 21 wells, anywhere from 10 to 15% of each well, and basically prove that it's worth a big player, Chevron, Shell, whatever it may be, or some big private equity group. It's worth them coming and buying this up and continuing to hold on to it for the next 10, 20 years, as most oil and gas opportunities are. And then there's some other sections of Texas and Wyoming that are natural gas. There's a part in Colorado that's actually was oil, but because Colorado has kind of moved to the left, it's actually now for water, which is pretty interesting. So you combine all of that together and you get this big value add play where you get your tax benefit, you get a monthly cash distribution, which ebbs and flows. Their target is anywhere from 8 to 12% annual. So really solid cash flow still, considering. And then, ultimately based on all of their, forecasting and everything is, the ultimate goal is to 3.5x at the exit. So they've already done it once. They 3x'd. Here's the only concern. 3.5x sounds like a huge number, and it is. Mm-hmm. But I've looked at everything. I've dove deep into it. I've had other people look into it. So many people were worried that it was predicated on the price of what oil and natural gas were going to be at the time of exit, in 3 to 5 years. And it is to an extent, but the forecast for 3.5x only requires $85, barrel of oil, which we're at like 82, sub 82. We might even be, a little bit up there now. And then $5 for natural gas, which I think the last time I checked natural gas was like $2.75. So it really doesn't require this big, massive, jump in oil and natural gas prices. It's really predicated on, what they call like peak drilling, peak performance, right? How many barrels a day of oil and natural gas are you actually able to produce? And so that's going to be the biggest factor in determining, right? Which is just like real estate, right? It's just like, is rent going to be able to continue to go back up, right? And so just like in real estate, when you use conservative underwriting, right? Conservative assumptions, especially right now, it's the same thing here, right? Conservative prices of oil and gas, which are very, very, natural prices for both, right? 85 for barrel, $5 or for oil, $5 for gas. And then ultimately, how well can we, pun intended, how well can we prove these wells, are going to be able to produce? And then ultimately, bundling it all together between all the different areas and packaging it up and selling it off to a much bigger player.
Okay. Yeah, that's very interesting. What is the typical hold period, or what are y'all looking at from an underwriting standpoint? Obviously, it can and probably will vary, but what's...
Yeah. So this one stands out a little bit because typically with oil and gas, you're, maybe like you're going to drill 3 wells and you're going to sit on them for 10 plus years, right? Like I got presented another opportunity, another fund opportunity, and it's a 10-year hold period, 8 to 10 years, because it takes time, right? And then you sit on these things, right? And boom, boom, boom. This one is different. It's 3 to 5 years, right? So not very long, because ultimately what they want to do is that value add strategy of like, okay, we want to prove it's here, and then bring in a big player to come and, buy up the whole operation. Either buy up the whole operation, do the drilling themselves, right? If you were to sell off to one of the bigger players, or if it's more of an institution, private equity, they'll contract them to do the drilling. In this case, it's King Operating Corporation. They'll continue to have them. And then obviously the institution will just buy out all the investors at, X premium. And what's really cool too is in the next 18 to 24 months, once they've drilled about half the wells, they'll sell off about 25% of the working interest, which is basically the interest of the investors, and return all of the investors, ideally return all of the investors' initial principal. And then you're just, running on house money.
Yeah, no, that's cool. What about you mentioned at the beginning, everybody's starting as a GP. Now, are these the initial investors, or just all the investors for this start as a GP and then convert?
Yeah. So all the investors start initially as a GP, right? So in theory, you are exposed to, the risk that the general partners have in oil and gas. Now, the good news about that is obviously one, the tax advantage. You can choose to come in as a limited partner right from the start, right? Okay. And we do have professional passive investors who don't have active income. And so there's no need for them. So they'll just come in as limited partners and everything will go just like normal as a passive investor. But when you're exposed to the risk, the good thing is there's never been a claim that has gotten past the insurance, right? The errors and omissions, or I can't remember exactly what they call it in because the leasing companies that they lease the equipment from, they have to have insurance. Right. Every player has to have their own insurance. And so when you get to King, they have their own insurance. And so there's never been a claim that's gotten past the insurance.
Yeah.
In the history of oil and gas for land, I should say for land drilling. That's a caveat, but this is all land drilling. So you can feel comfortable knowing that, knock on wood, there's never been, no investors that started as a GP has ever actually been exposed to any kind of insurance claims. And the insurance claims are like, wild claim, like stuff that just is also on its, doesn't really have a big chance of happening. So.
Yeah. Okay. That's neat. I'd like to continue to hear more about that. I know there's a lot of people doing something similar right now, and just it's always had a little bit of interest for me. So, but extremely helpful if you're being able to knock over the active income and really just bring that down. I did that as well when I bought the short-term rental. Did that with I qualified as a real estate professional, but, taking 100% bonus depreciation,
gotta love it.
I sold a property and was going to be paying a decent capital gains tax on it. And because of the short-term rental, I was able to kind of wash away that, those funds. So it was good.
And oh, by the way, you can't do that in the public sector, at least to my knowledge. So there's that too.
Right. Okay.
Which as soon as you get into a debate with someone who wants to die on the public hill and you bring up the tax advantage, they have nothing to say because there is nothing to say. You can't beat it. It is literally written to the IRS code. Like hard assets have this advantage that, equities and paper does not. That's just what it is.
Yeah, exactly. I mean, all of it's designed to encourage certain activities, and it's not the investors necessarily. Maybe us lobbying a little bit for it, but it's not necessarily us, creating it. And so it's just playing by the rules and just knowing what the rules are. And
totally.
The word loophole, I hate to hate to hear that because
incentive.
It's not. It's just an incentive, right? It's not a loophole in the law. You didn't find something that, wasn't that the IRS wasn't aware of. It's just taking advantage of the opportunity that they've given and kind of, working that strategy. So
1000%. And speaking of, I really hope that we get back to the 100% bonus depreciation.
Yep. I do too. I'm hoping there'll be a change in, not to get political, but I'm hoping there'll be a change. And
if there's regime change, it's going to do really well for a couple sectors, real estate and private equity and oil and gas. So
right, exactly.
Sweet. I'm in both of those. So that works well.
Exactly. How about, a lot of people are on the sideline, Jonny, right now, and they're looking and they're saying, gee, the sky's falling. Every time I turn on the news, I'm hearing about, inflation. I'm hearing about the national debt. Why is now a good time to invest in whether it be oil and gas, real estate, whatever it may be?
Gosh, that's such a great question. I've talked ad nauseum on my own podcast about this because it is my biggest fear for investors is sitting on the sideline too long. So I'll break it down. So first of all, if you're watching mainstream media to get your news, you need to stop right now. If your investment decisions are being made off of mainstream media, please call me, please call Keith. Let's set you up with some correct data sets where you can actually make some informed decisions and not these very biased decisions. So I'll get that out of the way. That's first and foremost. Second thing is, some of these deals that you're seeing, and we'll even take oil and gas out of it, right? We'll just kind of stick to real estate. Some of these deals that you're seeing that are not that sexy when it comes to the numbers, right? Very conservative underwriting, right? 6 pref, maybe 1.6 to 1.8x multiple, 16% IRR. Some of these are going to be home runs, right? Mm-hmm. In 5 years, we don't know where we're going to be, and we could be back up in a hockey stick, and you would have missed out on those deals. And that's, the opportunity cost is, not even quantifiable at that point, right? So that's first and foremost. Some of these deals are gonna 2.5x your money, right? Especially in some of these top markets, right? I know that rent is plateauing, but that's not going to stick around forever, right? Eventually interest rates are going to come back down. Asset prices will start going up. NOIs will increase, so on and so forth, right? So that's first and foremost what I tell people is some of these deals are going to be really good.
Yeah.
And even though they don't look that sexy right now, that's one thing. Number 3, you need to throw out what's happened in the last 3 years out. We're done. No longer are you going to 2.5x your money in 18 months, right? Like we saw in Phoenix and Austin and some of these crazy deals that were happening, right? Those days are gone. We're back to the 3, 5, 7 year holds. This is what it looks like normally. And, interest rates are going to settle. In my opinion, they're going to settle somewhere in the 4.5% to 6% range, right? Once everything clears up. And that's obviously we could do a whole podcast just on that, but they will settle and asset prices will go back up. And then the other thing too, that I tell people is, this is cliche, but scared money don't make money, right? We've all heard that. But also, if you sit on the sidelines too long, it gets really, really hard to get back into the game, right? Like if you were to use a sports analogy, right? Imagine sitting on the bench for the whole, let's say you play the first quarter and then you sit on the bench for the second quarter, you got halftime, then the third quarter, then you try to come in the fourth quarter and you have no flow, right? So it's the same thing here. If you sit too long, then some of these deals, you start to just really, your mind starts to justify why you're sitting out. And then all of a sudden, some of these deals come full cycle and you're seeing these returns and you're like, oh shoot, I've missed out. And it just gets really challenging when you're sitting on the sidelines for too long to get back in. And so what I tell people is it's extremely important now more than ever. And this should always be number one, but it's very important to do your due diligence on who you're investing with. And I know everybody wants to point to track record. This is a biased opinion of mine because I'm new to the game, but I will say that track record isn't everything, right? Certainly it is a factor. And I'm not saying don't take it into consideration, but I have experienced investors who are investing with me and don't even have a full cycle deal under my belt. The reason is because I'm leveraging these amazing operators, right? So instead of me going out and buying these deals and being like, yeah, come do this deal with me. It's my first 50 unit ever. It's like, no, these people have done this exact same thing. This is their 4th one or their 5th one, right? Maybe nothing's gone full cycle yet, but this is their cookie cutter deal. This is what they do. This is their market. They've proven that they can do it. You can look at, what they've done, on their other deals thus far, even though it hasn't gone full cycle. So that's first and foremost is who you're investing with. And if you invest with the right people who care about capital preservation, which is why you're seeing the transaction volume way down and why you're seeing these, run of the mill 16% IRRs is because they care about capital preservation. They want to make sure that they're getting into a deal that A, they can actually turn around, and B, that they can preserve your capital and that over the next 5 years, they can actually implement their business plan and give you a good return. Now, you might not see cash flow, which again is why I, introduced this oil and gas deal because, I had to find another opportunity for my cash flow investors. Mm-hmm. But if capital preservation is number one to you before cash flow, then really you should just be finding a good operator who cares about that as well. And you align with your values. And there's no reason you shouldn't be staying in the game.
Yeah, I agree. One of the sayings I keep hearing, and I think is so true that it's really not about timing the market. It's about time in the market, right?
1,000%.
When you jump in, I hear about, we started flipping homes this year as well, being a partner. And, of course, I got a lot of, whether it be family members, whether it be my spouse, it's now really a good time. And I'm like, now is actually the perfect time.
The best
for
time
us to really be able to get into it, obviously we want to be extremely conservative about the exit and how much we're going to be able to sell it for. But now is a fantastic time to really start to build it up. So I
love it, because to me right now, what you're seeing is, the old adage, right? When the tide goes out, you see you swimming naked, all of those different sayings, right? Like you said, listen, you can dollar cost average in the private world, just like you can in the public world. And that's all that's happening right now is you're just dollar cost averaging, right? And right now it's a little bit, it's not ideal, but there's still great deals. And what's happening now is you're seeing who the good operators are, who can actually hang. It got put really well to me that we're all training at altitude, right? You think again back to sports and training, right? These guys who train at high altitudes, right? That's what we're all doing right now. We're all training at altitude. Some of us are sucking wind. It's a little bit challenging, but there's headwinds up there. But ultimately what's going to happen is those of us who are investing now, paying attention now, we're the ones who in 5 years, 10 years especially, are going to look back and be like, oh man, I am so glad I didn't sit out, because this is actually the irony is this is where the money is made, is in these moments right here, right? You hear it constantly, right? When there's blood in the streets, buy real estate. I mean, that was,
right.
Almost, that was 100 years ago, but still, I don't really think you can say that anymore, but the principle remains true. And this is why you see, I follow a couple accounts on social media, right? You've got these private institutions that are licking their chops because they know, you're starting to see the multifamily fallouts happen. Seems like almost daily now, some of them hitting mainstream news, some of them not, but you're starting to see it. And the ones that have set up their portfolios correctly are the ones that are going to capitalize. And it's important to get on the list of those people. Do your due diligence, get on as many lists as possible. I tell people attend as many webinars as you possibly can. Yeah. Because at least this way you're going to learn about different deals and learn about different operators. And, you can't understand if someone's conservative unless you've seen someone who's a little bit speculative, right? And seen some of these different deals. And if you're not looking at enough deals, and listen, everybody, there's some investors out there who have their maybe 3 operators and those are the only ones they invest with. And that's totally fine. But if you're new to the game or you've never made your first investment, you should be looking at as many deals as possible. I tell people to pick their market, their asset class, and the operator's not last. Like that's not in a specific order, but it's important to know where and what you want to invest in. And then from there, go and pick the best operator in that respective market and asset class.
Yeah, I agree. I think, you got to have all of those. And yeah, it makes sense. So, let's see, we're running maybe just a little bit long, Jonny, on time, but I've got still some questions for you. So, yeah, if we could first, maybe we'll go to, how people can find out more about you, how they can invest with you, all that good stuff.
Yeah, totally. So I am getting ready to launch a video series. I'm not sure if your listener base, I know you sent out a thing. It's mostly tech professionals. If they're new to the game, and you haven't made your first investment or you're getting ready to, I'm about to launch a video series for brand new investors, 5 steps to your first passive investment. That is easy. It's the same name as my podcast, cashflowchronicles.com. You go there. That will get you the video series. It will also put you on my list where you'll hear about my deals. The only way to hear about my deals, obviously the oil and gas 506C, I'll talk about it, but I do 506B deals as well. So if you're not accredited, you can still invest. That is what I love about this industry as well, is there are plenty of good operators out there doing deals where non-accredited investors can get in, but you can only hear about that if I know you. And the only way for me to know you is for you to join my list. So if you're new, I would say go to the cashflowchronicles.com. If not, just go to cattanicapitalgroup.com and click top right corner, become an investor. Get on my list. You'll get a bunch of tons and tons of value, just tons of material. I love educating. That's my favorite thing to do. I've obviously got the podcast. That's another way, Cash Flow Chronicles.
Yeah.
But yeah, list is the best way because I keep track of my list. I reach out to my list. So that's the number one way. And my cell phone number and email are also on that same page. So if you want to call me, do it. No one ever does. That is the irony of this. And it's fascinating because when I put my cell phone number on there, I was like, man, am I going to get blown up? But I don't know what it is. Nobody calls. So I challenge your listeners to give me a call.
There you go. All right. Sounds good. All right. I've got two other questions I ask every guest. And one of those being, if you were just getting started in your investment career, what advice could you give somebody?
It's a great question. I would say, obviously, we've talked a lot about due diligence and doing your research, and that is great. And obviously, it's important to be educated. But the biggest thing that I see with new investors, I'm seeing with my friends, is analysis paralysis. Be careful of listening to too many podcasts, reading too many books, taking on too much information, right? Sucking from a fire hose, because what it will do is I promise you will overwhelm you and you won't end up taking the step. That's why I break it down for people. Pick your market, pick your asset class, find the best operator, do your due diligence and go. Because if you pick 8 markets and 4 different asset classes, and then all of a sudden you've got as many operators, you're going to be overwhelmed and you won't do anything. So make it as simple as possible for yourself and, do your due diligence. But remember, you can do too much and it can keep you out of the game. So my advice to people is make it simple and then take the leap. And, there's obviously no guarantees, but you can see, right? Just a little bit of research will show you what wealth can be truly built in the private sector.
Yeah. And let's see, how about, I think great advice, by the way.
Thank you.
Then what about any book recommendations that you have?
Just like anything, or are we talking investment wise or?
We can go with anything. I'll
give one of each,
too, but yeah, that'd be great.
So, this is kind of an investment book, but I am obsessed with Ray Dalio. If my goal one day would be to sit down with him, ideally for a podcast, but even if I could just be in the same room as him would be amazing. So Principles is my number one, probably favorite book that I've read, thus far in terms of nonfiction, investment. So for newbies, one of my favorites is right here on Passive Investing Made Simple, Anthony Vicino and Dan Kruger. I've had both on my podcast. Great people. Anthony and I have developed a relationship as well. It's really a great book, easy read to really break down a deal, right? Understand the makeup of a deal and what it's like being a passive investor. And it makes it very simple. So those would be my 2.
Great. Fantastic. Well, I've enjoyed our time together, and I think we're ready to call it a show. So thank you so much, Jonny. Appreciate you.
Yeah, absolutely, Keith. Thanks so much for having me.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.